Whatever the transaction paid, how much credit transaction, how much cross transaction, will bifurcate it. What are the credit transactions or what are the cash transaction, day-to-day transaction. What are the transactions I told you? It may be cash transaction or it may be credit transaction, business transaction. Whatever you purchase will not take into market value, only real cost value will be taken into consideration. I am Dr. B.S. Subramanya, called by name Dr. BSS, Professor in Commerce and Management, Vidhyaashram, First Aid College, a Temple of Excellence, MYSURU. In this session, I am going to have Financial Accounting 1, First Semester, Unit 2, Session 1, BCom, in favor of Introduction of Accounting. Now, I am going to explain what do you mean by accountancy, what do you mean by debtor, what do you mean by creditor, what are the principles of account. It may help you in forwarding the final account. Okay, we'll start with debtor account, creditor account, principles of accounting. Accounting. Accounting is defined as an art of recording, classifying, and summarizing in a significant manner and in terms of money transaction and events which are in part at least financial character and interpreting the result thereof. So transaction means transfer of property from one person to another person. I will repeat, transaction means transfer of property from one person to another. There are two types of transaction. One is called cash transaction, another is called the credit transaction. Transfer of property from one person to another for a cash, it is called cash transaction. Transfer of property from one person to another for a promise is called credit transaction. When the word called transaction comes, it includes both cash transaction and credit transaction. In India, credit transactions are more and cash transactions are less. Then, it is an art of recording and classifying. According to the merit, we classify and summarizing the significant which are in part. All character, all the events have been represented in the form of money only. Recording and maintaining, say, features of accounting, recording and maintaining all day-to-day business transaction. So whatever the transaction paid, how much credit transaction, how much cross transaction, will bifurcate it. What are the credit transactions or what are the cash transaction, day-to-day transaction. Systematically set under a particular books now, giving the result of business transaction at the end of an accounting period. At the end of the accounting period, we will summarize all the transaction, how much cash transactions are, how much credit transaction are, what is the end result. How much received, how much money to be received, how much paid, how much money to be paid. How it is? How much received, how much money to be received, how much paid, how much money to be paid at the end of the year. Fulfilling all the static requirements regarding the maintenance of books of account, making internal and reporting. So we have to make the internal also, you have to make the external reporting and also see that how much money to be received, how much money to be paid at the end of that financial year. Then objectives of accounting is important to maintain proper record of business transaction. So you have to record such a way that it should be full proof transaction. It may be cash transaction or it may be credit transaction. To ascertain the profit or loss of the business, at the end of the year, we have to ascertain whether the firm earn the profit or suffer the loss. The major goal of every businessman is to know that whether we earn the profit or suffer the loss. To know the source of revenue and items of expense, first we have to understand where the income has been, how the expenditure have been bifurcated. How it is, how the income has come, revenue means income has been, how the expenditure has been made during the year. Then, to ascertain the financial position of the business, financial position of the means how much asset we are having, how much liability you have to pay in our accountancy. Assets minus liabilities is equal to capital. This is your financial position. What is the financial position mean? How much asset we are having, how much liability you have to pay, what is the capital at the end of the year. When you compare to last year, whether the financial position has been improved or not, that we are going to find. Asset means land, building, machinery, furniture, cash in hand, bills receivable. Liability means creditor, bills payable, bank overdraft, provision for taxation, outstanding expense. Out of the asset, liability will be deducted, difference is capital. This can be written as A, L is equal to C, or A is equal to C plus L. This is called accounting equation. A minus L is equal to C, or A is equal to C plus L, or A minus C is equal to L. This is asset minus capital is equal to liability. We'll move on. Accountancy. Accountancy refers to systematic knowledge of accounting. It explains why, how to prepare the books of accounts, and how to summarize the accounting information and communication it to the interested party. According to Eric Kohler, accountancy is theory and practice of accounting. Accountancy is the theory as well as practice of accounting. What we say we are going to practice. How to maintain the books of account, how much you received during the day, how much you received during the month, how much you received at the end of the, all will be summarized to know that how much you have received, how much you are paid at the end of the year. Then, fundamental principles of accounting. So, I will explain. The entire accountancy have been divided into three groups. One is called personal account, one is called real account, one is called nominal account. Which are the three are personal, real, and nominal. What is personal account? Any accounts which connected to person is called personal account. It is Rama's account, Krishna's account, X account, Y's account. Even bank account is also called personal account because bank follows with the name. Which are the three accounts are personal account, real account, and nominal account. What is personal account? A personal account is one which deals with the person. Only name will come. Raju's account, Rama's account, Krishna's account, X account, bank account. The rule for that, rule of personal account, debit the receiver and credit the giver. Debit means left hand side, credit means right hand side. So rule is debit the receiver, credit the giver. The person who gives, his account should be credited. The person who receives, his account should be debited. Then come back, real account. A real account is one which shows, deals with the reality. Real accounts is one which deals with the assets of the company. Real accounts are accounts of asset owned by a business concern, for example, cash, land, building, machinery, furniture. So real accounts are those accounts which has got reality. It may be land, it may be building, it may be machinery, it may be furniture. Rules are debit what comes in, credit what goes out. If the building is sold, cash is coming in, building is going out. If the furniture is purchased, furniture is coming in, cash is going out. So asset, so whatever comes in should be debited, what goes out should be credited. Debit what comes in, can credit what goes out. Then nominal account. Nominal accounts are the accounts of expenses and loss. All the expenses account should be debited. So it deals with the incomes and expenses. All the expenses should be debited. All the income should be credited. The rule is debit all expenses and losses, credit all incomes and gain. Which are the three accounts are personal account, real account, and the nominal account. A personal account is one which deals the accounts of person. A real account is one which deals the accounts of asset. A nominal account is one which deals the accounts of profit or losses. So, personal account gives examples of Raju's account, X account, even bank account. Real account is the reality of the business, whereas a nominal account, all expenses should be debited, all income should be credited. Then, accountancy cycle. Here, one is called business transaction. What are the transactions? I told you it may be cash transaction or it may be credit transaction, business transaction. Second one, subsidiary books, secondary books. Which are the books are purchase book, sales book, purchase return book, sales return book. Okay. Purchase means credit purchase, sales means credit sale, purchase return, whatever the goods purchase, return to a seller. Sales return means when you make the sale, returns from the seller is concerned. Cash book, bills receivable book, bills payable book, and journal proper. Then, here in the business cycle, what will happen? No, first in the business cycle, transaction. First, we prepare the journal, journal to ledger, ledger to trial balance to trading and profit and loss account, and a balance sheet. How it will come? First is the journal, journal to ledger, ledger to trial balance. From trial balance, you are going to prepare trading and profit and loss account and a balance sheet. So these are all the books to be maintained here. Say that transaction, accounting cycle, ledger, trial balance, final account. Final accounts contain what? Trading account, profit and loss account, and a balance sheet. How the business cycle goes? No. First, transaction starts with the journal, journal to ledger, ledger to trial balance to final account. Final accounts contain trading account and profit and loss account and a balance sheet. Accountancy. Accountancy principle, which constitute the body of the doctrine associated with the accounting, serves as an explanation to the current body. Accounting principle may be classified into two types. One is called accounting concept, accounting consumption. So entire accountancy can be divided into two groups. One is called accounting concept, second one is accounting convention. We'll move on to accounting concept. Accounting concepts are the fundamental ideas or basic assumption underlining the theory and practice of accounting and are broad working rules for all the accounting activity. The concept says it has been broadly divided into some groups according to it analyze the accountancy. First one, business entity concept. This is the first concept. This concept recognizes business unit as a separate and distinct entity from the owner. Means, if a businessman has been introduced 10,000 into the business or 1 lakh into business, here there are two entities. One is the receiver of the money, he is a person, he is though it's a owner. One is the receiver of the money, one is the giver of the money. Here as a business, it receives. As a person, he gives. The same person, if I am the owner, if I pay the money into the business, who is the receiver? One unit as a business is the receiver. As a person, I am giving, it's another unit. Same person will be act as a two person. If I contribute as a owner, so money is going out from me. Who is the receiving unit? The company is receiving one unit. Who is giving unit? The person is giving the unit. This is the concept. The concept recognizes business unit is separate and distinct entity from the owner. The person of the transaction owner is separated from the business. So business is separate, the person is separate, they say. Going concern concept, this is also known as concept of continuity. Under this concept, it is assumed that the business will continue forever. The business does not stop, it will be continue forever. And identify period. On this concept, only financial statements are prepared. That means here it's a continuous in existence. It may be calendar year, it may be financial year. Start with January, end with December. It is called calendar year. Start with April, end with March. It's called financial. It's a continue in existence. All things are measured in terms of money only. Then money measure concept. According to this concept, the accounting records should reflect only those events which are capable of being measured in terms of money. All things are measured in terms of money only. According to this concept, all asset, liability, incomes, expenditure are regarded in terms of it at the time of spending it. Here, only we are taken into cash into transaction. All things have been measured in terms of money only. Whatever the expenditure paid in terms of money only, whatever the money received in terms of money only. All things are measured in terms of money only. Then cost concept. As per this concept, all assets acquired by the concern are shown in the accounting record at cost only. Whatever you purchase, you will not take into market value, only real cost value will be taken into consideration. Whatever the asset purchase, here the market value may be changed, but you take only the cost price. These assets may not be reflect their market value. Question of market value, it may go more, it may go less, but we take only the cost concept. Then dual concept. This is an extension of double entry principle of accounting. This is the dual concept according to which asset acquired by the business out of capital investment by the owner are shown as the asset side of the balance sheet, and their equivalent value in terms of money will be shown on the liability side as capital. If we have been purchased an asset worth of rupees 1 lakh, building worth of rupees 1 lakh, it is considered as an asset. It will be shown on the asset side of the balance sheet. The same amount will be shown on the liability side of the balance sheet as a capital. Means our asset is our capital. If we purchase a building worth of rupees 10 lakh, what is 10 lakh? The value of the asset. The value of the asset will appear on the asset side of the balance sheet. The same amount will be shown on the liability side of the balance sheet as a capital. Means our asset is our capital. What's the intention? Our asset is our capital. Then, dual aspect concept. For every corresponding debit, there is a corresponding credit. What is the rule? For every corresponding debit, there is a corresponding credit. Then accounting period concept. According to going concern concept, here a business firm operates an identified period. However, as per this concept, the result of this business option are revalued as a fixed period, normally in a year. So they will fix 1 year for the entire transaction. The year may be calendar year, it may be financial, January to December, calendar year, and April to March is called financial. We fix it for the particular expenditure and income. Realization concept. According to this realization concept, which is also known as the revenue recognition concept, how much amount you have received. Revenue is considered as being earned on date which is to be realized, on the date on which goods and services are transferred to the customer, either for cash or on credit in a personal term. Here, realization means how much revenue have been realized, what time you are realized. At the time of realization, we take into account during that year what time your revenue has been realized in terms of money. How much money you have received, from whom you have received, at what time you have received during that particular period. It may be month of January, it may be month of December, it may be month of, that will be recorded. Then, matching concept. The objective of financial accounting to find out the trading result by preparing trading account and profit and loss account, revenue, expenditure, and income is known as matching concept. According to this concept, so whatever the transaction, you are going to prepare trading account and profit and loss account. Trading account gives the result of gross profit, whereas profit and loss account gives the list of net profit or net loss. Trading account is purchase and sale. All indirect expenses will be shown in the profit and loss account. So trading account gives the result of gross profit or gross loss. Profit and loss account gives the result of net profit or net loss. Then we'll move on. Accrual concept. This concept distinction between right to receive cash and actual cash received. Similarly, obligation to pay cash and actually cash paid. In other words, under this concept, outstanding and prepaid items are accounted. Here, how much you have paid, how much money to be paid, how much you have received, how much money to be received. To be paid is called outstanding. If you paid more, it's called prepaid. To be paid, it's called outstanding. To be paid in the after 3 months, after 4 months, it's called outstanding expenses here. If you pay, by chance, you have to pay every month 10,000. By chance, if you pay 12,000, how much paid more? 2,000. That is called the prepaid. For 10,000, you paid only 9,000. How much money to be paid? 1,000, which is called outstanding. If you pay less, it is called outstanding. If you pay more, it is called prepaid. This concept says, hope you understand. Here, all things are, especially the concepts are most important here. All the concept has to be measured in our accountancy. And what is actually an account? An account is a summarized business transaction relating to person, firm, or a company to know the profit or loss. Here, transaction means cash transaction or money transaction. So, any goods transfer from one person to another is called transaction. If it is transfer for money, it is called money transaction. If you transfer, he is going to say that I will pay your money after some days, it is called money transaction. So accountancy deals with such a way that all in terms of money. So generally we have got two types of transaction. One is cash and it's called credit transaction. So we are going to prepare here journal, journal to ledger, ledger to trial balance, trial balance to the final account. And we are going to prepare a trading account, profit and loss account, and balance sheet to find out the financial position of the concern. In the next session, we are going to start the final accounts of sole trader. This session, we have already completed concepts and convention. According to concept, you are going to work in the next session called final account of a sole trader. So 15 marks question. In the next session, I will give the format of the sole trader and a problem. What are the adjustment has come, how to deal with. Till then, goodbye. Meet in the next session with a problem. Till then, goodbye.